Chapter 4. The Perils of a Pavlovian. As many more individuals of each species are born than can possibly survive, and as, consequently, there is a frequently recurring struggle for existence, it follows that any being, if it vary however slightly in any manner profitable to itself, under the complex and sometimes varying conditions of life, will have a better chance of surviving and thus be naturally selected. Charles Darwin on the Origin of Species, Introduction. In our view, it is folly to forego buying shares in an outstanding business whose long-term future is predictable because of short-term worries about an economy or a stock market that we know to be unpredictable. Why scrap an informed decision because of an uninformed guess? Warren Buffett, Annual Letter to Shareholders, 1994. You are going bald. Not because of age, but because you have been tearing your hair out. A few months ago, you committed to investing $100,000 with a money manager. This fund manager did not want to raise cash and said that he would call commitments if he saw attractive opportunities to invest in the market. He made a strong pitch with a snazzy PowerPoint presentation and, like everyone in the industry, he promised to be long-term oriented. He also claimed that he does not like to lose money as if everyone else does, and that he carefully assesses the quality of businesses and buys when everyone else is selling. Very Buffettesque. Very old world. You have heard the same spiel from everyone, but he seems quite sincere. Or at least he put on a good act. A few quarters have passed and he has called $40,000 from you. At the end of the quarter, the value of your $40,000 investment is $38,000. You know that the market has been a bit weak lately, so you ignore the minor loss. You are a patient sort and don't fret over the value of your investments daily like many of your friends. But when you check your investments next quarter, you see that the value of your portfolio is now only $32,000. You have taken a hit of 15% in a single quarter. To rub salt into your wounds, the fund manager demands $15,000 more from you. He is entitled to. You have signed an agreement with him that commits you to keep investing until your $100,000 limit is reached. You invest the additional $15,000. One more quarter goes by and you are aghast to discover that the value of your $55,000 is now only $39,000. You are down 30% within 6 months. The fund manager repeats the same mantra, we are long-term, patient, blah, 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 while asking for an additional $15,000. You talk to some of your friends who appear to be stock market experts. All of them advise you to stop investing more and to withdraw your remaining capital promptly. Unfortunately, your lawyer advises you that there is no way out. Not only can you not redeem your capital because you have agreed to a lockup for many years, but you must honor your commitment. With great reluctance, you invest an additional $15,000. Your total investment is now $70,000. You have read Buffett's great annual letters and listened to his interviews on TV. You remember that he advises investors not to check their stock holdings obsessively. Hence, this time, you decide to wait 6 months before reviewing how your portfolio has performed. Kudos for your patience. The day finally arrives. You haven't felt this nervous since the first time you used a fake ID to enter a bar. You open your account statement with increasing dread. Your worst fears are realized. Your $70,000 investment has now almost halved to $36,000. Your portfolio has lost about 40% during the past 6 months. Oh, and your money manager is threatening to ask for more money. Apart from continuing to tear at your remaining hair, what should you do? The horns of dung beetles. Maybe they have the answer. The how versus the why. Dung beetles love poop. Duh. With about 8,000 species, this cleanup crew of the insect world eats poop. They build their nests with poop, live in those nests, and lay their eggs in them to sustain their larvae. Check out Figure 4.1 for a small sample of the astonishing variety of dung beetles. Among insects, they have the unique distinction of caring for their young. Dad provides food and mom tends to the nest. Many years ago, while taking a poop in the open in Masai Mara in Kenya, don't ask, I heard them before I saw them. They scurry noisily at a surprisingly brisk pace. The males have impressive-looking horns and the 8,000 species have almost as many different kinds of horns. Their shape resembles rhinoceros horns, elephant tusks, deer antlers, and even a serrated knife. Their size varies from very small to massive. Some are even larger than the entire dung beetle's body. What explains these horns? One way evolutionary biologists describe them is through hormonal, developmental, and genetic mechanisms. For example, a 2019 Science article provides evidence that dung beetles use wing genes to grow their horns. The wing genes get turned on in the early stages of the growth of the horns. Later, these genes switch off and a new set of genes grows and shapes the horns. An article in the Journal of Insect Physiology explores the types and quantities of hormones that control the length of horns in males. It showed that the hormone methoprene has a significant influence on the production of horns. These scientists are asking how questions. How do the horns grow? How does horn length differ? Another route of exploring the cause of horns is to understand the adaptive nature of them. These are why questions. Why did horns arise? Why do they increase the fitness of the beetle? Why can horns be considered an adaptation? The selectionist explanation contends that the horns of male dung beetles allow the bearer to garner more resources, defend their nests, and compete for the best females, thereby reproducing more than the males without horns. For example, an article in the Journal of Insect Behavior describes an experiment providing evidence that males with larger horns get preferential access to females and thus can be considered adaptive. The same article also describes the adaptive value of small horns in some males. These males have greater mobility and can sneak around the larger males to mate with the females. The first category of explanations for the dung beetle's horns addressing the how question are called proximate causes, and the second, addressing the why question, are ultimate causes. Proximate mechanisms explore immediate physical influences on a trait. The history of the organism determines ultimate causes, specifically the role played by natural selection to favor one trait versus another. To elaborate further, let's talk about sex. Or more precisely, polyandry in the predatory mite species Neocoelus californicus. Polyandry implies multiple matings by the female of a species and is the opposite of polygyny, wherein a male succeeds in mating with multiple females. Bateman's principle, named after an English geneticist, argues for the prevalence of polygyny in the animal kingdom. He contended that since females invest much more in offspring than do males, they are the limiting factor over which males compete, leading to polygyny. However, polyandry is more widespread than Bateman believed. In many species, females are not just waiting around to get impregnated, they are actively scouting for multiple partners. And one of these species is the mite N. californicus. But what drives this mite to become polyandrous when the dominant trend in the animal world is toward polygyny? Peter Schaussberger and his colleagues tackled this question in a PLOS 1 article, and they came up with two different sets of explanations, one proximate and one ultimate. The scientists discovered that the ultimate cause of polyandry in N. californicus consists of both direct and indirect fitness benefits. Females that mated multiple times produced more offspring than females that mated just once, and these offspring also survived longer. As for the proximate cause, the authors identified a key one. First mating duration. If the female's first mating period was below a certain threshold, 150 minutes, the likelihood of their continuing to seek male partners increased. The immediate cause of females seeking more sex was a lack of sex. Who says science is boring? Ernst Mayr, one of the greatest evolutionary biologists of the 20th century, proposed the proximate, ultimate duality in a landmark article titled Cause and Effect in Biology in the journal Science in 1961. Using the example of bird migration, he posed the following question. Why did the warbler on my summer place in New Hampshire start his southward migration on the night of the 25th of August? He proposed 4 causes for this migration. First, an ecological cause. The bird would starve if it stayed in New Hampshire for the winter. Second, a genetic cause honed over millions of years that induced the warbler to respond to external stimuli and gain selective advantage over warblers that did not migrate. Third, an internal physiological cause that propelled the bird to leave once the number of daylight hours dropped below a certain level. And last, an external physiological cause that was reflected in a sudden drop in temperature on August 25th. The warbler was already physiologically ready for migration, and this sudden cold wave made it leave that day. Mayr called the first 2 explanations ultimate causes and the latter 2 proximate causes. Problems of proximate focus. Among all the philosophical issues that we have imbibed from evolutionary biology, recognizing the difference between proximate and ultimate causes is right on top. We want the businesses we own to increase in value over the long run. And the only way for this to happen is for the company to perform well over many years, preferably decades. Investment success may not correlate with business success for a day trader or short-term investor. But for us, the ultimate success of an investment is almost entirely dependent on the ultimate success of the business. If you accept this premise, then as permanent owners, we should focus exclusively on the quality and performance of the business over the long run. And that is what we do. However, this is easier said than done. In today's world of Facebook, Instagram, Reddit, Twitter, WhatsApp, and other soul-destroying inventions, it is not easy to escape the din of proximate noise that can drown out the desire to seek sources of ultimate success. When there is a specter of a Greek default, an announcement of reduced jobs growth in the United States, OPEC negotiations break down, the Federal Reserve hints that the days of low interest rates are over, or company revenue falls, stocks can fall. Similarly, a bullish projection by the International Monetary Fund (IMF) on world growth, the recapitalization of banks in China, the success of a new product launch, or the increased pace of vaccination for a global pandemic can lead to higher stock prices. All these are proximate causes of price movement, and all are divorced from what could ultimately lead to the business success or failure and hence a higher or lower market value of a company. The question we investors don't ask often enough but should is relatively straightforward. Does this proximate cause have anything to do with the cause of ultimate business success? The interesting thing about proximate causes is that they are almost always evident in screaming newspaper headlines and hyperventilating news anchors. Ultimate causes, thankfully, are way too dull for media coverage. Why thankfully? I will get to it. The sections that follow describe 4 categories of proximate causes of share price gyrations: macroeconomic, market-related, thematic, and company-specific factors. This list is not exhaustive, there are way too many to count. But after reading this, I hope you will be able to spot a proximate cause when you encounter it. Proximate macroeconomic causes. We live in an uncertain world. But it's actually worse than that. We live in an uncertain hyperconnected world. On balance, hyperconnectedness has benefited humanity. I get to eat Norwegian salmon in Singapore. My use of the adjective worse here is limited to the impact of hyperconnectedness on my community, that is, fund managers. Before I became an investor in 1998, if someone had told me that inflation or U.S. employment data would affect the stock price of a paint company in India, I would have concluded that that person had no idea what they were talking about. But this is precisely what happens. On October 27, 1997, the Dow Jones Industrial Average suffered one of its largest single-day drops in history. It fell 554 points, or 7.2%. For the first time in its history, the New York Stock Exchange halted trading. All major world markets were affected. Hong Kong's Hang Seng fell 6%, the United Kingdom's FTSE fell 6%, the Australian market fell 7%, and Germany's DAX fell almost 6%. In short, if you were looking for a definition of financial panic, your search would have ended here. The proximate cause of this mayhem? The spreading of the Asian financial crisis. It had all started on July 2, 1997, when the Thai government floated the baht since it did not have the foreign currency to support the baht's peg to the US dollar. The currencies of Indonesia, South Korea, Malaysia, and the Philippines also suffered precipitous declines. Many companies in these countries had borrowings in dollars, and these firms started defaulting on their payments. Table 4.1 tracks the US and UK market indices at the time, along with the stock prices of a few well-known businesses. The US market decline is for October 27th, Monday, relative to October 24th, Friday. The UK market reacts to the US market's movement with a day's delay owing to time difference. Thus, the UK market data is for October 28th, Tuesday, relative to October 24th, Friday. Every number in the first column is negative. Why? Why did Walmart, a local US business, and Boeing, a global enterprise, fall on October 27th? And why did Thai bond defaults impact Unilever, which earned about 70% of its revenue and profits from the developed world in 1997, and BP, a global oil company? Proximate paranoia confused with ultimate reality. The evidence is in the second column, which provides the index levels and stock prices 6 months after October 27, 1997. The Dow, as well as the FTSE, were up 25%, and the dramatic upward movement of companies like Walmart, Diageo, and Unilever may have led to the firing of some fund managers who had pressed the panic button on October 27th. If you want to lash out at the fund management community for being impulsive and trigger-happy, go ahead. But please don't blame us for being inconsistent. Whenever the markets get excited about a macroeconomic event, the fund managers behave predictably by riding the proximate bandwagon of stock prices. And then they repent at leisure. Fund managers have a Pavlovian reaction to macro or market data. Will interest rates be higher? Sell. Will inflation be lower? Buy. If the fiscal deficit shoots up, sell. Or is it a buy? Most businesses should be and are relatively immune to short-term macro movements. As shown in Table 4.1, their stock prices, for some inexplicable reasons, are not. Some argue that for certain types of businesses, say, banks or financial companies that rely on lending and deposit-taking, interest rates should significantly impact long-term performance. Hence, interest rate movements should be proximate and ultimate causes of business performance. Let's look at the following data of stock price changes for 3 large Indian banks over 20 years from December 31, 1999 to December 31, 2019. HDFC Bank 81x, ICICI Bank 33x, State Bank of India 16x. During these 2 decades, the Reserve Bank of India had increased or decreased interest rates more than 50 times. Rates vary between 5% and 12% with wild gyrations in between. More importantly, all these banks were subject to the same regime of interest rates and other macro factors. If you were an HDFC Bank shareholder, did it matter what the interest rate was or at what pace the Reserve Bank of India changed it? HDFC Bank's business, and therefore its stock price, did spectacularly well because of its CEO Aditya Puri, one of the most outstanding leaders in Indian corporate history. In October 2020, The Economist called him the best banker in the world. Interest rates, current account deficits, exchange rates, and other such esoteric measures did not get in the way of Puri achieving excellence. I am not cherry-picking here. Over the long run, well-run businesses create a lot of value irrespective of the macroeconomic environment. Do we seriously think Amazon, JP Morgan, Michelin, Nestle, Siemens, Tesco, Walmart, Zara, and other excellent businesses are held hostage to inflation and fiscal deficit? If the business and stock price performance of exceptional companies is immune to macroeconomic perturbations, aren't we, as investors in those companies, better off ignoring the economy? There is another big problem with considering macroeconomic data while analyzing individual businesses. Let's confront this headache through the example of tires. There are many listed tire businesses in India, so it should be a happy hunting ground for us. Let's say the World Bank announces that India will grow its GDP by 8% next year. This seems like good news for the country. What about tires? Someone could argue that GDP growth will lead to an increase in personal wealth, which would lead to consumers buying more cars and hence more tires. Should we buy a tire business then? But wait. A sales increase is not the same as a profit increase. The primary raw material for tire companies is rubber, which accounts for about 60% of revenue. What if rubber prices shoot up in anticipation that Indian tire businesses will need to buy more rubber next year? This is getting way too complicated. You need a number-crunching analyst with a lot of computing power at their disposal. Your super smart analyst builds their 100-gigabyte Excel model after burning the midnight oil for a couple weeks and predicts that rubber prices will be benign. Phew. Should we buy a tire business now? Hold on. How do we know what strategy or tactics the dozen or so tire companies will employ in a favorable environment? What if one of the smaller companies decides to wage a price war to shore up market share? Some have done so in the past. Or what if the dominant player increases its advertising budget significantly by sponsoring international cricket tournaments? Let's assume the same astute analyst predicts that no company will misbehave. This analyst is brilliant. Okay, are we ready to invest now? Not at all. How are we to know the relative growth of various tire segments that will ultimately impact overall industry profits? The truck segment is the largest and the least profitable, whereas two-wheeler tires are the most profitable but generate only a tiny fraction of industry revenue. Thus, if the truck tire segment grows faster than the rest of the tire market, the profits of tire companies may decline. You ask the analyst to forecast segmental growth. After they have come up with the answer again, you go back to the drawing board. And now you are perturbed by an uncomfortable realization. Since tires are highly capital-intensive, they can significantly impact the debt level of a business, which could affect its robustness and the stock price. How are you to predict which tire company will invest and how much? I know. Back to a resourceful analyst. I could go on, but it gets worse or better if you are that smart analyst on overtime pay. Note that in the tire example, I have tried to predict the performance of a business by analyzing only GDP growth. But macroeconomic data encompass a much more comprehensive range of indicators such as employment level, exchange rate, inflation, government deficit, money supply, current account balance, and many more. How can we assess all these factors in the context of a tire business? And fund managers don't invest only in tires. Are we supposed to repeat this mega exercise across the dozens of industries and hundreds of companies we track? Also, given the connectedness of the global economy, should we also incorporate the macroeconomic data of other countries into our decision-making? Are we ready to give up now? We have seen two problems with treating macroeconomic factors as critical proximate variables. First, we noticed that even big macro events, like the Asian financial crisis, are uncorrelated with longer-term stock price performance. Second, taking the example of the Indian tire industry, we concluded that using proximate economic data to assess industry and company performance is very hard, if not impossible. The third problem with using economic data is the most obvious of all. No one knows anything. Okay, that is exaggerating a bit. But only a bit. Since even expert economists are abysmal at forecasting the economy, why should we investors squander our time giving it any importance? I assume you will agree that an economist's most important task is to forecast a recession. This would enable the government to take the necessary steps to prevent widespread pain and suffering. In March 2018, the IMF published a working paper titled, "How Well Do Economists Forecast Recessions?" The authors compared real GDP forecasts with actual growth data for 63 countries from 1992 to 2014. They showed that while GDP contracted by an average of 2.8 percentage points during recessions, the consensus forecast from the year before the recession was a growth of 3%. Worse, even during the year of the recession, the average forecast was a contraction of 0.8% when the real contraction turned out to be 2.8%. Prakash Langani, one of the authors of this IMF paper, told The Guardian in an interview that according to his analysis, economists had failed to predict 148 of the last 150 recessions. The record of failure to predict recessions is virtually unblemished, he said. One would have thought that with a greater volume of data, more computing power, and better algorithms, our ability to forecast would have improved over the years. Yeah, right? In the same Guardian article, Mark Pearson, the Deputy Director for Employment, Labor and Social Affairs at the Organization for Economic Cooperation and Development in Paris, said, "We are getting worse at making forecasts because the world is getting more complicated." Way to go, Mark. I know that many investors spend a lot of time poring over economic data. Maybe they have figured out a way to factor in exchange rate movement or the external debt levels of the country in their decision-making. I am unable to do so. I do not know how to translate any economic indicator into the prospects of a specific business. We ignore every piece of proximate macroeconomic information. We do not believe these data help us assess the ultimate success or failure of a business. We have no economic advisors, we do not talk to economists at banks or brokerage houses, and we do not discuss any economic indicators in our team meetings. Their weightage in our investment decision is a big zero. Proximate market-related causes. I don't fraternize with folks in the financial services industry to exchange ideas or information. However, when I started my investing career with Warburg Pincus in 1998, I spent a fair bit of time with fund managers and finance professionals connected with the Indian equity markets. I had a consulting background and wanted to understand the workings of the capital market and its participants. I thought I had a lot to learn. I was right, just not in the way I had imagined. After just a couple months at Warburg, I could predict the exact words of a finance industry professional's greeting. It wasn't "how are you" or "how's it going" or just "hello." It would almost always be "Kia lagta hai?" Translated from Hindi in stock market parlance, this means "what do you think the market will do?" I remember being confused. Here I was, a novice trying to understand how the markets work while this expert was seeking my opinion. Do they not know? It took me a while to conclude that they don't. No one does. The previous section explained market decline owing to a proximate macroeconomic problem, the Asian financial crisis. Maybe you did not notice my sleight of hand. I claim to know the cause of market correction. The fact is that I do not know why the markets corrected, but it looked like the crumbling of Asian currencies played a role. I had established a connection between the market movement and economic data, however spurious that connection may have been. But there are many other occasions when the market moves because, well, it moves. Such is the nature of markets. The proximate causes of market movements are unknown and, in my view, unknowable. Let's go back to July 24, 2002. The Dow soared 489 points, the second best point gain ever and the best percentage gain since 1987. The reason? Even after reading many news articles, I am not sure. Anyway, according to various media sources, the rally was the result of congressional negotiators reaching some kind of an agreement on corporate fraud. Also, some executives who had been defrauding the cable company Adelphia were arrested. Whatever. Let's now look at Table 4.2 on markets and how stock prices in the United States and the United Kingdom reacted to this great news. As you can see, over the following 6 months, the Dow in the US shrugged off the gains of July 24, 2002 and declined by 2%. The significant upward moves in the share prices of large companies like Walmart, Citigroup, and Boeing could not keep pace with the euphoria of this one day. Boeing declined by a fourth over the next 6 months. Even more remarkable is the behavior of the markets in the United Kingdom. You would have thought that the so-called corruption investigations in the United States should not affect the UK markets. Well, we fund managers never cease to amaze. The FTSE 250 went up by 1.5% the day after the US markets moved up 6%, and the stock prices of large companies, as shown in the first column of Table 4.2, shot up by 2 to 9%. These are not small moves for companies with large market values. The euphoria did not last. Just 6 months after the event, Rolls-Royce was down by almost a third, and BP and Diageo had declined by 15% or more. Why did fund managers in the United Kingdom start piling on to BP, Rolls-Royce, and Diageo on July 25 after a huge increase in the US indices on July 24? The explanation that comes to mind was offered by the great John Maynard Keynes when he opined that the stock market players were playing a complex guessing game. He asked us to imagine a game in which competitors pick the 6 prettiest faces from 100 photographs. The winner is not the one who picks the prettiest faces but whose choices match the average of all the competitors. How would you play a game like this? My approach would be to not choose the 6 prettiest faces and instead spend my time guessing which 6 the other players will select. Before I were to start feeling smug about my second-level strategy, I would realize that a more insightful competitor would go a step further to a third level. They would try to guess what the average opinion expects the average beauty to be, and so on to even higher levels. Keynes had learned from bitter experience that this market-guessing game is a colossal waste of time. In the 1920s, he used a detailed economic model to predict market levels and failed to see the great crash of 1929. He also underperformed the market during this period. He switched to picking stocks and, like Buffett, eschewed diversification. He declared the right method of investment is to put fairly large sums of money into enterprises one thinks one knows something about. No wonder he turned out to be an excellent investor. Keynes managed the endowment of King's College, Cambridge, from 1924 to 1946. During this 22-year period, he compounded the college's wealth by almost 14% a year. If someone had invested £100 with Keynes at the start of 1924, it would have been worth about £1,675 at the time of his death in 1946. The same money invested in the UK stock market index would have been worth only £424. Astonishingly, this period included the Great Crash of 1929, the Great Depression, and the Second World War. Should the financial world not have absorbed Keynes's insights? December 2019 looked like any other December, and the Wall Street stock market strategists were at it again, forecasting market growth for 2020. Since the year 2000, the median Wall Street forecast has never predicted a stock market decline in the next year. Yes, you read that right. Not once did the forecasters believe that the stock market could go down. The reality? The market fell on 6 occasions. The median forecasts from the year 2000 to 2020 missed the actual number by 12.9% points, more than double the average annual increase of 6% over these years. Back to December 2019. Remember that no one was aware of the COVID-19 pandemic then. The median consensus among the forecasters was that the market would rise by 2.7% in 2020. If the forecasters had known then that a pandemic would rage across the world from March 2020 until December 2020, what do you think their forecast for 2020 would have been? We will never know, but I bet they would have predicted a huge fall in the market. In any event, the S&P 500 rose by 16.3 percentage points in 2020. But 2020's pandemic was a once-in-a-century event, and we should not hold it against the forecasters that they were wrong by 13.6 percentage points. Fair enough. What if we assess the forecast of an acknowledged master forecaster from early May 2020? Only 8 months of the year remain. The pandemic has been raging for 4 months and the dire impact on the economy seems quite evident. I would think that an expert could go wrong at this stage, but probably not by much. Harry S. Dent Jr., called by some the contrarian, accurately predicted Japan's economic collapse, the dot-com bust in 2000, and the election of Donald Trump. After receiving his MBA from Harvard Business School, he joined Bain & Company and now runs an independent research firm. He is a regular guest on CNBC, CNN, Fox, Fox Business, Good Morning America, and PBS. He has also been featured in Barron's, Fortune, Business Week, The Wall Street Journal, and many other publications. He also publishes a monthly newsletter called the H.S. Dent Forecast. In short, Dent embodies as much expertise as an expert can muster. In early May 2020, in an interview with ThinkAdvisor, Dent predicted that the market would peak in August 2020 and that investors might be able to make a return of 5 to 10%. He advised them to get out and counseled against buying. How wrong was he? The market kept rising until December 31st, and from the time of Dent's interview in early May, the S&P 500 rose 32%. Even if you take the highest number of 10% returns in Dent's band, that is an error of 22 percentage points over 8 months, or an annualized error of 33%. Oops. Before you blame me for choosing a forecaster who turned out to be egregiously wrong, I challenge you to find me an expert who asserted in May 2020 that the market would be up by 25 to 30% by the end of December. I could not find one. Trust me, I tried. To be fair, I have not met a single finance professional who claims that markets can be predicted. So why do industry players spend so much time obsessing over future market levels? Why do fund managers devote enormous time and effort obsessing over what other fund managers think and do? Flawed incentives, false comfort, one-upmanship, you name it. It doesn't really matter. We ignore all market forecasts. Well, maybe not entirely. I do look at them on days when I want to have a good laugh. Proximate thematic causes. At the end of Annus Horribilis 2020, I realized I was wrong by $6 billion. In early September 2020, Nikola was a stock market darling. The startup had listed barely a year earlier at a valuation of $4 billion. Its value had since quintupled to almost $20 billion. Led by its charismatic founder, Trevor Milton, who was often compared to Elon Musk, Nikola was planning to develop semi-trucks powered by hydrogen fuel cells and batteries. It had just announced a partnership with GM wherein the Detroit giant would get an 11% stake for $2 billion in return for a contract to engineer and build Nikola's semi-trucks. On September 10, 2020, a reputed investment fund and short seller called Hindenburg Research published a scathing report titled Nikola: How to Parlay an Ocean of Lies into a Partnership with the Largest Auto OEM in America. The first line of the report states that Nikola was an intricate fraud built on dozens of lies over the course of its founder and executive chairman Trevor Milton's career. In 2017, to prove that its technology worked, Nikola shared a video titled Nikola 1 in Motion, which showed its prototype semi-truck speeding along a road. Hindenburg claimed that the company had simply towed an ordinary truck to the top of a hill in a remote area and had filmed it rolling down the hill. After the report was published, Nikola felt compelled to acknowledge this fact by stating Nikola never stated its truck was driving under its own propulsion in the video. What else was a speeding truck supposed to show? The road? The revelation of this barefaced lie was just the start of the lengthy report. Hindenburg's research unearthed several more problems. Nikola did not have a battery technology despite Milton's claims to the contrary. It did not possess hydrogen fuel cell expertise. Milton had a history of taking technology from others and then claiming it as his own. Milton also had a track record of troubled partnerships that ended in failure, lawsuits, and recriminations. And Milton had claimed that Nikola's corporate headquarters were completely off-grid and used 3.5 megawatt solar panels, though no headquarters existed. I could list many more damning assertions made by Hindenburg in its lengthy report, but suffice to say that the future seemed bleak for Nikola. Trevor Milton resigned within a few days of the report and GM ended its partnership discussions with the company. The Securities and Exchange Commission and the Department of Justice launched their own investigations. Unsurprisingly, the stock price started crashing. Here's my question for you. What do you think Nikola's market value was at the end of December 2020, 3 months after the Hindenburg expose? Remember that the company had no battery or fuel cell technology, had no prototype, its founder had exited ignominiously, GM had terminated the partnership, and the government had begun investigating fraud. My answer would be close to zero. Nope. It was $6 billion. The Hindenburg report appeared to be fact-based. They backed up almost all their assertions with documents, photographs, text messages, videos, and interviews. I am in no position to double-check their research. However, the facts that Milton resigned and GM terminated the partnership seem to indicate that a reasonable portion, if not all, of the report was credible. If so, how does one explain a $6 billion valuation for a company like Nikola? That's an unfair question because I doubt anyone fully understands how companies are valued. But in this case, I want to offer a two-word answer: thematic investing. The theme being new age automotive companies will rule the world. Automotive tech startups have been a rage since 2020. According to an article in the Financial Times in January 2021, these companies had amassed a market value of $60 billion, but most had not generated a single dollar of revenue. And why didn't they have any revenue? Because, like Nikola, they didn't even have a product. The popular saying, fact is stranger than fiction, is tailor-made for the valuation of new age automotive startups. The FT article names 9 listed startups, the largest of which was QuantumScape, valued at $19 billion. This company projects its first revenue of $14 million in 2024. In 2028, just 4 years after generating its first revenue, the company expects to touch $10 billion revenue. As a matter of comparison, after recording its first revenue in 2008, Tesla took 9 years to cross $10 billion. And remember that Tesla had the lion's share of the market in those years. The QuantumScape website proclaims that the company's mission is to revolutionize energy storage to enable a sustainable future. Its investors range from blue-blooded venture capital firms like Kleiner Perkins and Lightspeed to car companies like Volkswagen and SAIC. And there were many others. Hyliion's market value was $2.6 billion and it was planning to manufacture hybrid trucks, Velodyne LiDAR, $3.9 billion, sensing solutions for autonomous vehicles, Fisker, $4.1 billion, electric cars, Luminar Technologies, $10.1 billion, object detection technology, Canoe, $4 billion, electric vehicles. You get the picture. A foolproof method of checking the interest level in a concept or theme is to analyze Google searches using Google Trends. If you do so for the term electric vehicles between January 2014 and January 2019 in the United States, you will see a relatively flat trend. However, between January 2019 and February 2021, interest in electric vehicles quadrupled. Now check out the dates the companies just mentioned went public. Nikola, June 2020. Velodyne LiDAR, September 2020. Fisker, October 2020. Hyliion, October 2020. QuantumScape, November 2020. Canoe, December 2020. Luminar, December 2020. I don't know if the IPOs of these companies increased the interest level in the search term or whether the increased searches of electric vehicles were a leading indicator of public listings. Maybe they just fed each other in a positive feedback loop. Whatever the case may be, as you can see, there is a strong correlation between the theme of electric vehicles and the IPOs of these businesses, a classic example of a strong proximate mechanism at work. In addition, in January 2021, there were at least 8 to 10 more private startups ready to go public, all with obvious-sounding names like ChargePoint, EVgo, Lightning Motors, Lion Electric, and Motive Power Systems. If the market value of the listed companies holds, I bet that in the next few years there will be dozens more listed companies with this theme. These companies, valued at billions with not even millions in revenue, epitomize investment strategies based on proximate themes. Like almost every proximate theme before and since, the automotive tech theme has 3 properties. It hypes up total addressable market, TAM, is simple to understand and is actionable. First, TAM. Every theme I have encountered since the start of my investing career in 1998 plays on the enormous size of the addressable market. And the size is usually so large that it dwarfs the businesses currently operating in that industry or theme. No wonder it is usually the most salient proximate cause of a theme gone wild. In March 2021, a UBS report touted the zero-emission trucking market as potentially $1.5 trillion in size, and current manufacturers and startups raced to grab dominance. Tesla, which did not manufacture trucks in March 2021, had revenue of only $32 billion in 2020. In my experience, there is only one problem with chasing a proximate theme based on TAM. It's useless. It makes astrology-based forecasts look respectable. TAM is pointless because it does not tell us whether any profits will be made, and even if a business can be profitable, TAM is silent on who will make that moolah. One of the largest TAMs is that of apparel and footwear. The U.S. market for apparel and footwear is about $370 billion. It is also one of the hardest places to make money. The lack of robustness of this industry was also evident during the pandemic when scores of apparel and footwear companies declared bankruptcies. Brooks Brothers, Centric Brands, Century 21, G-Star, JCPenney, J.Crew, John Varvatos, Neiman Marcus, Tailored Brands, and many more. Someone forgot to tell these companies that their TAM would save them. Even pre-pandemic, most apparel brands struggle to grow and make a decent income. Take the example of a well-known brand like Gap. It hasn't grown in the United States since 2007, with sales almost flat at $15 to $16 billion, and it achieved its peak net income of $1.3 billion back in 2014. Guess's revenue fluctuated between $2 billion to $2.6 billion between 2009 and 2020, and its ROCE hasn't crossed 10% since 2016. Abercrombie & Fitch's revenue in 2006 was $3.3 billion, and it grew to only $3.6 billion by 2019. It too has not earned more than 10% ROCE since 2014. The global market for apparel and footwear is about $1.9 trillion, a colossal TAM. But the only apparel companies that seem to consistently grow their sales and churn profits are H&M, Uniqlo, and Zara. Other industries like airlines, restaurants, infrastructure, banking, and retailing are the same. Their TAMs are quite high, but most industry players don't make any money. So what use is TAM to a long-term investor? The second reason for the seductiveness of a proximate theme is its simplicity. Even a casual reader of business news will be aware of themes like e-commerce, renewable energy, electric vehicles, fintech, food delivery, artificial intelligence, self-driving cars, infrastructure, and biotech. Unlike economic forecasting, which is full of jargon like GDP and monetary supply, a layperson can relate to themes. Anyone can understand what renewable energy is and that the country needs a lot more infrastructure investment. For the automotive tech startups, the simple argument goes as follows. Electric and autonomous vehicles will conquer the world, and since Tesla's market value is $700 billion, shouldn't this theme capture trillions of dollars of value in the near future? And if so, why shouldn't a startup be valued at billions of dollars? The premise is seductive because it is straightforward. Third, it is actionable. If you believe in the theme that consumers will order more food sitting at home because it is cheaper and easier than dining out, you can invest in DoorDash or Deliveroo. Are you interested in an electric vehicle company with actual revenues? Hail Tesla. Do you believe in the providers of technology rather than the car? Velodyne LiDAR beckons. Do you think trucks are a bigger opportunity? Nikola is peening for you. Why does it matter that its founder was probably a charlatan? I don't know where the theme of automotive startups will end up in 2025 or 2030. What I do know, based on the history of capital markets and new age technologies like railways and the internet, is that this theme will face its comeuppance someday. Many readers will, not fondly, remember the theme ascendant in the early 2000s that home prices will rise forever. Any bank or financial company riding this theme was rewarded with increasing stock prices. Now we know that home prices don't keep rising, and pricier homes bought with heavy borrowing need to fall in price only slightly for panic to set in. No one investing in the theme homes are an unbeatable investment could have imagined that the following marquee names would go bankrupt or need a huge bailout. Lehman, assets of $691 billion, Washington Mutual, $328 billion, CIT Group, $80 billion, Thornburg Mortgage, $39 billion, General Growth Properties, $30 billion, and several more. The Indian market is no different. At various times since the start of my investing career in 1998, I have witnessed the following themes create and then destroy billions of dollars of value in the capital markets: real estate, infrastructure, education, microfinance, consumer lending, and technology services. In addition, until early 2022, on paper, the following themes have created, but not yet destroyed, a lot of value in Indian private markets. EdTech, FinTech, e-commerce, software as a service, SaaS, logistics, and social media. Based on history, many of these concepts will crater, I just don't know which ones or when. How should we separate the proximate causes from the ultimate ones when there is euphoria or bearishness in a theme? Unfortunately, I am not aware of a foolproof method for doing so. But here is what we do. We define our unit of analysis clearly as the company. Not the economy, not the market, not a theme. We care about the fundamentals of the company, nothing else. We have never invested in a theme and never will. Again, just to be clear, I am not implying that thematic investing is flawed. Maybe some fund managers can do it successfully. We would if we could, but we can't, so we won't. Proximate company-specific causes. In December 2016, after almost 3 years of Vaibhav Global's continuous underperformance, for the first time we actively debated whether we should exit entirely. Were we confusing an ultimate cause for a proximate one? Vaibhav is a retailer of low-priced jewelry and other accessories in the United States and the United Kingdom that sells through TV and the internet. One can shop at www.shophealthy.com in the United States or www.tjc.co.uk in the United Kingdom. Please do, you will find its deals unbeatable. Vaibhav competes primarily with home shopping giants like QVC and HSN, as well as hundreds of other online and offline retailers. We invested in Vaibhav in late 2007. After underwhelming performance for a few years, the company grew its revenue and operating profit at an annualized rate of about 30% from the year ended March 2011 to 2014. In July 2014, the stock price hit an all-time high of INR 174, our buy price was INR 48. Sunil Agarwal, the founder and CEO, had done a stellar job in recent years. However, from April 2014, the company's sales and profits started falling primarily owing to 3 self-inflicted missteps. First, Vaibhav did not respond to a significant strategic move by competition in the United States. Every major competitor of Vaibhav had started offering customers an option to pay in installments. However, Vaibhav refused to follow in their footsteps. Sunil did not want to take an unnecessary financial risk. Also, Vaibhav's average sale price is only about $20 to $25 per piece compared to $50 to $100 for competition. Sunil thought that customers would not care about installments if they got a quality product at a low enough price. It turns out that they did. Second, the company faltered in designing and implementing a robust technology platform. The company lagged behind all its peers on the quality of its customer-facing websites and apps. Even some of its back-end technology platforms, example, which helped decide which products to merchandise when, were outdated and inflexible. Vaibhav's internet sales accounted for 16% of company revenue, whereas this number was 51% for QVC. The company fired its head of technology, but the new leader was taking time to fix the problems. Last, Vaibhav lost a few key senior managers. Sunil had fired some of them, but some had left for greener pastures. He was also finding it hard to attract quality talent to fill the vacancies. From the year ended March 2014 to March 2016, sales fell by 2%, but profits declined by almost 70%. Our OCE collapsed from 55% in 2014 to 13% in 2016. The stock market had reacted appropriately. Vaibhav's stock price was INR 54 in December 2016, a fall of almost 70% from its previous peak in July 2014. We were now in a dilemma. Were these problems a delay in responding to competition, the lack of a robust technology platform, a paucity of senior leaders, proximate causes of stock price decline? Or did these headaches reflect a more fundamental and long-term issue with the company? Were these issues fixable, or should we abandon any hope of revival? We are permanent owners in businesses and do not sell unless there is irreparable damage to a business. Were these lapses temporary, or would the company be able to overcome this adversity? As I have discussed in this chapter, we ignore proximate problems related to the economy, the market, and even the industry. But the dilemma is much trickier to address when the proximate cause of problems relates to the company itself. Suppose the sales growth and profitability of the company has declined in the past few quarters, whereas its main competitors showed no such struggle. How would you decide if the performance issues are related to proximate and hence temporary causes or ultimate and hence more permanent causes? In my experience, developing a method and an instinct to separate proximate and ultimate causes of failure or success when they relate to a company event is invaluable for a long-term investor. I have been an investor for more than 2 decades, and this is where I stumble most often. As usual, at the extremes, the decision is straightforward. If the share price declines owing to a downturn in 1 or 2 quarters, we ignore the decline, considering it a proximate event. But if the decline results from a loss of market share for 3 years in a row, we ask if there is something fundamentally wrong with the business. It is the gray area in between these extremes that creates the worst headaches for us. I do not know of any foolproof method of cracking the conundrum. The answer is almost always very company-specific. Vibe was in this gray zone. Maybe the proximate issues indicated ultimate problems, but maybe they didn't. We decided to stay with the business. Under Sunil's leadership, the company had performed exceedingly well until only 3 years earlier, and nothing had changed in the market since then. There were no new entrants, and customer behavior remained the same. More importantly, Vibe's competitive position of selling jewelry and accessories in the range of $20 to $25 remained intact even during the difficult years. None of its competitors was able or willing to match Vibe's value proposition. Also, as time passed, we saw Sunil taking timely steps to address the issues. Late in 2014, he started offering installment plans, which put a stop to customer attrition. Despite declining profits, he invested aggressively in building the technology team and infrastructure. Finally, as he promoted some internal staff to leadership positions instead of hiring from outside, we could discern some early signs of progress. Luckily for us, Sunil and his team did turn the business around. Sales grew by 11% annually from the year ended March 2016 to 2020, but more impressively, operating profits grew almost 5-fold. Our OCE jumped from 13% to 45% during this period, and the annual free cash flow almost quadrupled. The stock price jumped 6.5-fold from INR 54 in December 2016 to INR 352 in September 2022. Vibe may have turned out well for us for now, but this was a touch-and-go decision. It could have gone either way. Our instinct to stay in business as permanent owners helped us stay the course. Most importantly, we got very lucky. The pain and the gain of headline harassment. Let's go back to the question I raised at the beginning of the chapter. You have sunk $70,000 in a fund that is now worth $36,000. Everything the fund manager touches seems to be heading down. Apart from continuing to tear your hair out, what should you do? Nothing. At the end of the anecdote, the time was March 2009. If you had done nothing and continued to hold the fund, your $36,000 would be worth a little more than $770,000 at the end of September 2022. Which is a multiple of 21.4 times over 13.5 years. In comparison, the main stock index grew 6-fold during these years. As you may have guessed, this was not a hypothetical situation. I have described what transpired at Nalanda. What you see in the numbers I've given is the result of our aggressive buying during the global financial crisis of 2008 and its dramatic longer-term impact on the fund's performance. The only change you would need to make is to switch dollars to rupees. Your patience would have paid a lot. As the Indian market started falling from March 2008, we started buying high-quality businesses, and we did not stop until early 2009. The further the market fell, the greater our buying frenzy was. In December 2008, the fund had delivered an annualized return called the internal rate of return, or IRR, in investing parlance, of -55%. And we continued to invest as much as we could. The fund's annualized rupee return as of September 2022 was 20.3% after payment of all fees and expenses. What allowed us to invest when the world seemed to be coming to an end? We ignored all proximate causes of stock price decline and focused exclusively on the ultimate sources of success of a business. Let's walk through an example. Our most successful investment to date is Page Industries. In October 2008, the company had a stellar track record of performance over more than a decade and was the #1 innerwear brand in the country. It had overtaken competitors that had started many decades before it entered India in 1995. Over the previous 5 years, the company had grown revenue at 32% per year and had earned 57% ROCE. On October 7, 2008, 3 weeks after Lehman's collapse, we bought 8% of the company for INR 455 per share. This was a 23% premium to the prevailing stock price of INR 370 per share. We took a notional loss the very next day after our purchase. In fact, the stock price did not cross our buy price for 6 months until April 2009. At the end of July 2022, Page was at INR 48,873, a multiple of 107 times our buy price. During this period, the Sensex went up 5.5 times. Our view on Page and 7 other businesses we bought during the financial crisis was that global events may affect the stock prices of high-quality companies but not their business strength. The fact that investors were dumping stocks was not a problem but an opportunity. Businesses' market valuations may take a hit but not their intrinsic value. The opportunity cost of not investing in troubled times far exceeds any near-term pain owing to notional losses. Our success with Page is only partly the result of our aggression at a time of market panic. It is largely the result of our unwillingness to sell a great business at any price. But more on that later. The title of Section 2 of this book is Buy High Quality at a Fair Price. This is a nice-sounding strategy but far from easy to implement in practice. The problem is that high-quality businesses are seldom available at a fair price. Markets are very efficient most of the time. However, when proximate causes get divorced from ultimate ones, markets can offer even great businesses at a fair price. We took full advantage of this temporary insanity to wade in all guns blazing. Our trailing 12-month TTM PE multiple for buying Page? 18 times. Can you believe it? This undeserved luck was the direct result of what I call headline harassment. While we were busy buying stellar businesses in 2008 and early 2009, the following headlines and others like them appeared in the most widely read Indian business daily, The Economic Times. Mark-to-market losses worry India Incorporated. July 18, 2008. Economic activity is slowing down fast, August 25, 2008. Financial crisis, are MNC jobs secure? September 26, 2008. Sensex Nifty hit new 2008 lows, October 16, 2008. Economic recession, layoffs shift balance of power, November 15, 2008. Why did Sensex crash from 20K to 10K? December 20, 2008. It is common knowledge that lousy news attracts way more eyeballs than good news. We may blame the media for this bias, but psychologists have shown that people prefer reading bad news and remember it better. The media simply exploit an existing prejudice. In an article titled On Wildebeests and Humans, the preferential detection of negative stimuli in the journal Psychological Science, researchers showed that subjects remembered negative words faster and more often than positive ones. In times of crisis, this predisposition gets a steroid boost. Imagine reading the newspapers and watching TV in the weeks and months surrounding the Lehman collapse. Headline harassment would have taken its toll across the globe. No wonder wonderful businesses were finally available at a price we could not refuse. In sharp contrast, there was no celebration of business as usual at the high-quality companies that were becoming part of our portfolio during this period. No headline screamed, WNS processes another mortgage application, Triveni's factory manufactures turbine number 39 for the year, Page Industries adds 2 more retailers today in the city of Aurangabad, or Carborundum factory in Chennai finishes another shift. Earlier I wrote, ultimate causes, thankfully, are way too dull for media coverage. Now you know why. There is one more important reason we could embrace a diametrically opposite attitude to that of many of our peers in 2008. We are fortunate to have long-term investors, primarily U.S. university endowments and U.S. and European family offices who have supported our aggression when the world seemed to be coming to an end. Not even one investor defaulted on their commitment. No one, I hope, tore at their hair. I know that many private equity and hedge funds could not persuade their investors to commit more capital in 2008. We were very fortunate. I don't make predictions, but after the global financial crisis of 2008, I told myself that I was unlikely to witness the same degree of stock market panic for decades. I couldn't have been more wrong. At the height of the COVID-19 pandemic dread in March 2020, the Indian market fell 23%. We could not stop buying, and our investment in that single month was 12% more than in the previous 4 years combined. In sharp contrast, the foreign portfolio investors in India withdrew $8.7 billion from the Indian stock market in March 2020. We continued to be hyperactive until September 2020 and then had to stop because the prices of the businesses we were interested in had increased sharply. The total amount we invested in 2020 turned out to be more than one-third of our cumulative investments over the 13 years from 2007 until 2019. I don't know if we made the right decision. However, I do know that the proximate worries of impending doom for businesses like tires, enzymes, boilers, diagnostic services, vehicle lending, and sanitary ware were divorced from their ultimate causes of success. We had been tracking many of these companies for about a decade and had great confidence that they would overcome any short-term pain over the longer run. In any event, we will know soon enough. 2030 isn't far away. Chapter Summary. Evolutionary theory has taught me that we can reimagine investing by ignoring proximate causes of stock price movements while focusing on ultimate explanations of business success. 1. Evolutionary biology explores natural phenomena by searching for proximate and ultimate causes. Proximate mechanisms explain immediate influences on a trait. The role played by natural selection explains the ultimate cause of an organism's success or failure in an environment. 2. Thus, to understand the impressive size and variety of dung beetle horns, evolutionary biologists asked the proximate question, example, which network of genes was switched on? As well as the ultimate question, example, what is the adaptive value of the horns? Scientists understand that these are different types of questions with different types of answers and that both types must be asked. 3. The investing world, too, must differentiate between proximate and ultimate causes. Proximate causes of share price changes can result from the macroeconomy, the markets, the industry, or the company itself. Since proximate causes are highly salient, example, the Fed announcing an interest rate cut or a company announcing a slowing of sales growth, investors may erroneously overweight them in their decision-making process. 4. We ignore all proximate causes when analyzing businesses. We focus exclusively on the business fundamentals or the ultimate causes of the success or failure of businesses. 5. We were aggressive investors during the financial crisis of 2008 and the early days of the COVID-19 pandemic because proximate worries compelled the markets to overlook the ultimate causes of the success of many high-quality businesses.